Hi, I'm Doug Carroll. Welcome to Corporate Fixed Income Securities. This module is intended to provide viewers with a broad overview of corporate bonds and preferred stocks. The session will address some general issues regarding corporate fixed income securities, regarding their role in corporate capital structure and common risk factors, but the emphasis will be on the various types of corporate fixed income securities, their contract features, and investment characteristics. Before beginning the formal presentation, let me provide a brief overview of the topics that will be covered over the course of this module. The initial section will address corporate securities from the perspective of company capital structure, major risks, and some legal considerations. We'll first consider the role of fixed income securities in funding the business activities of corporations. That will be followed by a discussion of risks commonly faced by holders of corporate fixed income securities that holders of U.S. Treasury securities have effectively avoided. With corporate securities, there is more uncertainty about the return of principal, which is commonly referred to as default or credit risk. And for a significant number of corporate securities, there is uncertainty about the timing of any principal return due to embedded options for early retirement. The final portion of the initial section will address the contracts, which detail the rights and obligations of the issuer and investors, a document known as a trust indenture. The bulk of the module will address many of the commonly encountered forms of corporate fixed income instruments. The discussion of the investment characteristics of these securities will address both their implications regarding contractual cash flows, as well as their impact on risk and expected return. The presentation will look at a variety of different fixed income contract features, such as secured versus unsecured bonds, sinking fund bonds, and split coupon bonds. The discussion will also range over a number of different corporate market sectors or types of securities: high-yield securities, preferred stocks, and convertible bonds. Let's begin the discussion of corporate fixed income securities by considering the fundamental reason for their existence. In other words, from the issuing corporation's perspective. Why are such securities issued? What are the factors that influence a corporation's choice between issuing more common shares or issuing fixed income securities? And what are the impacts on the company of having issued fixed income securities? Before you is a common framework for presenting a company's financial situation, known as a balance sheet or sometimes as a statement of financial position. It's called a balance sheet because the two sides must balance. That is, the book value of the left-hand side must be exactly equal to the book value of the right-hand side. That balance is a consequence of the nature of double-entry bookkeeping and financial accounting rules. The left-hand side of the balance sheet lists the company's assets, things owned by the corporation that will generate future benefits for it. On the right-hand side are the liabilities, things owed by the corporation to others, and the equities, the owner's interest in the corporation. Corporate debt securities are issued as a means of borrowing money from investors. As the issuing corporation owes the bondholders the principal, debt securities are liabilities and so are listed in the upper portion of the right-hand side of the balance sheet. Companies can also raise funds by selling equity securities. As ownership interests, such securities are shown in the equity portion of the balance sheet, the lower right-hand side. There are two broad categories of equity securities: preferred stocks and common stocks. Preferred stocks will be discussed in some detail later in this session. They are being discussed here because despite the fact that preferreds are usually considered equity securities from a legal and accounting perspective, from an investing perspective they behave a lot more like bonds, ergo their inclusion in this session on corporate fixed income securities. The common stock represents the basic ownership of the company. The common shareholders' interests reflect both the proceeds to the company of the share issuance, the paid-in capital, as well as any previous earnings of the company that had not been distributed in the form of dividends, the retained earnings. The three types of securities being discussed, debt, preferred stock, and common stock, represent the interests of the providers of long-term funds the company has the use of. In the aggregate, they're referred to as the company's capital, or sometimes capitalization. Analyzing a corporation's capital structure, that is the amount and proportion of capital from those different sources, and the implications for the issuer's risk-return profile, is commonly an element in credit analysis and securities valuation. All the contributors to the company's capitalization do not have equal standing. The securities this session focuses on, debt securities and preferred stocks, are known as senior securities. Bond and preferred stockholders have a senior or prior claim on the company's assets relative to the claim of the common shareholders. In general, whether considering periodic interest payments versus dividends, or return of capital to holders of the various types of securities, distributions to the senior security holders have to be made in full before any distributions can be made to the common shareholders. There are several risks faced by investors in U.S. corporate securities that are significantly different from, or borne to a much greater degree, versus the risks faced by investors in U.S. Treasury securities. This exhibit captures one of the ways those differences in risk manifest themselves in the markets. That is, the difference between the yields on same maturity securities from the government and corporate sectors, or saying the same thing another way, the spread between the yield curves for those two sectors. This exhibit shows representative yield curves for the government and corporate sectors. Consider what's reflected in the rates on a given curve and what explains the difference between the rates, the spread, between the different curves. Let's start with the benchmark curve, the U.S. Treasury yield curve. Speakers and authors will make reference to risk-free securities or risk-free rates. That's insider speak for Treasury securities and the interest rates or yields on those securities. It's understood that an unspoken word is assumed to precede risk-free in either phrase. There is no such thing as an investment completely free of risk, even short maturity U.S. Treasuries. The only risk Treasuries are near absolutely free of is default or credit risk. That's because the government has a large tax base upon which to gather revenue, as well as the ability to create money to pay off its debts. So the Treasury yield curve indicates the level of default risk-free rates across all maturities. What about the corporate bond yield curve? For any given maturity, corporate rates are above Treasury rates. The spread between the Treasury rates and corporate rates is narrower at short maturities and widens as maturities lengthen. The spread reflects the market's perception of the greater risk associated with holding corporate securities. Note the phrase risk premia on the exhibit, as there are a number of different ways in which corporate securities are riskier than Treasury securities. The spread is wider at longer maturities because of the greater uncertainty associated with those risks over the long run compared to the short run. First, there's credit risk. Corporations have to generate cash flows to service their debt. For corporations, cash flow is obtained by selling something. Ideally, it's goods or services that can be sold at a profit. However, short-run considerations, such as the need to avoid default, might cause goods or services to be sold at a loss. Corporations can also sell assets or issue securities to raise money if that's appropriate. But ultimately, businesses have to be able to sell something to generate cash flows to meet their obligations. Governments don't face the same budgetary constraints. Governments have a legal authority to impose taxes and the police powers to enforce payment. Additionally, many countries, including the U.S., have the ability to create money, which makes available another avenue for obtaining monies to pay off debt that cannot be serviced with tax revenues. Several aspects of credit risk come into play. Naturally, the issuer's financial circumstances are the most immediate consideration. However, companies' financial prospects are not isolated from surrounding circumstances. Companies operate in specific market sectors or segments, thus their financial strength or weakness will be colored by the prospects for the sectors in which they operate. Treasury securities are the most liquid securities in the world, so all corporate securities carry a higher degree of liquidity risk. Investors expect to be compensated for the additional risk with a higher yield. Though upper investment grade corporates have reasonably good liquidity under normal market circumstances, even triple and double A rated corporates will be less liquid than treasuries, especially in periods when markets are under extreme duress, like the fall of 2008. Liquidity for even upper investment grade corporates will evaporate under those sorts of circumstances. Lower rated corporate securities, known as high yield bonds, face these same liquidity risk considerations to an even greater degree. There is one additional risk to consider here that is less obvious than the risks discussed so far. It's a risk that applies to nearly all fixed income market sectors at certain times. Certain sectors will be affected by this risk at almost all times. It's the impact on bond values resulting from any embedded options, especially options for early retirement. The specific consequences of such embedded options will be addressed in detail shortly. Here we'll simply note that embedded options may have an impact on price. In particular, the common type of embedded option, early retirement at the issuer's option, will have a very significant impact on bond prices as interest rates fall below the bond's coupon rate. Credit ratings are a common framework for expressing the relative credit risk of fixed income securities. The two largest providers of credit ratings are S&P and Moody's, or more formally, Standard & Poor's and Moody's Investor Services. While S&P and Moody's are the dominant players, there are a number of other significant competitors, such as Fitch's and Duff & Phelps, among others. This exhibit will delineate the investment-grade ratings from S&P and Moody's. From highest to lowest, the investment-grade ratings are AAA, AA, single A, and BBB, or BAA, depending on whose rating scheme one is describing. The difference in the symbols for the equivalent ratings are mostly a branding issue. The respective agencies want their proprietary credit ratings to be recognized as their own. S&P only uses uppercase letters. Moody's first letter is uppercase, followed by lowercase a's where appropriate. The top rating category is AAA, indicating the highest possible credit quality and the likelihood the bondholder will receive principal and interest in full in a timely fashion under almost any circumstances, even if the economy were to experience a steep recession or depression. There are no other gradations of this category, no AAA+, no AAA-, just AAA. Below the AAA category, the agencies use various markers as a method of recognizing finer distinctions between companies of relatively similar credit quality. Within each other broad investment grade rating category, relative credit worthiness is indicated by plus or minus signs in the case of Standard & Poor's system, by a 1, 2, or 3 in Moody's. Just below AAA for S&P is AA+, followed by AA, then AA-. For Moody's, the sequence is AA1, AA2, and AA3. S&P's plus is equivalent to Moody's 1. S&P's minus equivalent to Moody's 3. An unsigned S&P rating equivalent to Moody's 2. The same system of gradations is used across the balance of the scales, for the most part, all the way down to just above bonds in default. Here are the balance of S&P's and Moody's rating scales. What's shown here are the less than investment grade credit ratings. Securities carrying these ratings are referred to as high yield securities. The name recognizes the fact that such securities typically trade at yields to maturity significantly higher, 300 to 500 or 1,000 or more basis points above the yields on similar maturity treasury and upper investment grade corporate securities. These securities trade at such high yields because of the high degree of uncertainty about the issuer's ability to repay. However, investments with high levels of risk usually hold for investors the possibility for high returns. High-yield securities are also called junk bonds because of their relatively low credit quality. Please understand, junk bonds is a name, not an accurate descriptor of historic returns on this asset class. The high-yield sector is typically the highest returning sector of the fixed income market over almost any 5 or more year holding period since the 1920s. Another risk avoided by holders of U.S. Treasuries that investors in some corporate issues face is an uncertainty about the timing of principal return. Though a variety of bond contract provisions can lead to an accelerated maturity, the most common is early retirement through a call at the issuer's option. The price impact of that type of embedded option is illustrated on this exhibit. Whether callable or non-callable, bonds of either type will see similar price declines for similar increases in their yields as market rates rise and bonds trade at bigger and bigger discounts to par. That is illustrated on this exhibit at yields above Y star. The single solid price yield function in the diagram to the right of that point shows that both callable and non-callable bond prices behave similarly as yields rise further and further above their coupon rates. However, as market rates fall, the price behavior of callable versus non-callable bonds is distinctly different. That divergence of price behavior is illustrated by the separation of the price tracks for the two types of bonds at yields below Y star. For non-callable securities, as interest rates fall, bond prices become increasingly sensitive to interest rate changes. Each additional basis point decline in yields results in greater price appreciation. That's captured in the solid line function drawn from A to A prime. But with callable bonds, as rates decline, prices will tend to appreciate by smaller amounts with each additional basis point decline in rates. Negative convexity is the formal term for describing the decreasing rate of price appreciation as interest rates fall. The existence of an option for early retirement through a call places an effective ceiling on how much a callable bond's price is likely to appreciate as interest rates decline. That's illustrated in this exhibit in the line segment AB. The dashed line indicates how callable bond prices get less and less sensitive to interest rate changes as rates go lower. As a limiting case, imagine a bond that is currently callable or is approaching the first call date. Under such circumstances, where the issuer has the right to retire the bond currently or in the very near future, investors are not likely to be willing to pay a price too much above the call price, no matter how low interest rates go. The formal legal relationship between a bond's issuer and its holders is detailed in a legal document referred to as a trust indenture. For most publicly offered U.S. corporate bonds, such contracts are required by the Trust Indenture Act of 1939. The trust indenture is a contract between the bond holders and the issuing corporation. In simple terms, the contract states the rights of the bond holders, the obligations of the bond issuer, and appoints a trustee to monitor the issuer's compliance with the terms of the contract. By law, the trustee must be organized as a national bank or trust company. Any bond that is backed by the pledge of specific assets will be considered a secured bond. However, certain types of collateral are encountered frequently enough that market jargon has evolved among professionals to designate bonds backed by a given type of collateral. Some of the more common types of secured bonds are mortgage bonds, equipment trust certificates, and collateral trust bonds. Mortgage bonds are not the same thing as mortgage-backed securities. Mortgage-backed securities, discussed in a module on that topic, are securities where the holders receive cash flows that are ultimately derived from payments borrowers are making on their mortgage loans. Normally, the payments on the securitized loans will be the sole source of cash flow to investors in mortgage-backed securities. Cash flows to mortgage bondholders have nothing to do with pools of mortgage loans. Mortgage bonds are corporate bonds where the debt service is payable out of general corporate cash flows. What makes them mortgage bonds is that the issuing corporation has pledged real estate assets as collateral on the debt. Should the issuer not be able to pay debt service in a timely fashion, the trustee representing the bondholders could foreclose on the mortgage, take legal possession of the pledged property, and sell it to recoup as much of the debt as possible. Note the image on the exhibit of an electric power generating facility. One not familiar with mortgage bonds might question the appropriateness of the image. Historically, electric utilities have been among the biggest issuers of mortgage bonds, pledging their generating facilities as collateral. Equipment trust certificates are debt securities backed by operating assets of the issuer. Companies that tend to be the heaviest issuers of equipment trust certificates are airlines pledging their airplanes, railroads pledging their rolling stock, boxcars, locomotives, flat cars, etc., or trucking companies pledging their tractor-trailer rigs. Equipment trust certificates are issued to finance the purchase of those operating assets. The interesting twist here is that legal title to those assets is held by the trustee. This makes repossession of the assets in case of issuer default relatively easy. The same types of operating assets are used by many companies in those industries. Given the wide use of those various operating assets and the fact that the collateral is relatively mobile, equipment trust certificates are viewed as relatively safe. There will usually be a ready market for the collateral if the issuer defaults. Collateral trust bonds are bonds that are backed by securities held in trust as collateral. Corporations operating in any industry that are holding a substantial amount of financial assets might consider issuing such securities. For most corporations, putting securities they own up as collateral would reduce the perceived credit risk, permitting the bonds to be sold at lower yields than would otherwise be the case. Holding companies are a common issuer of collateral trust bonds. Holding companies are financial companies that buy securities of operating companies, often large enough blocks of shares to influence management, if not gain outright control. As a way of raising money to make additional investments, holding companies will sometimes put up the stock they own as collateral on bonds they are issuing. There is very strong incentive to meet the debt service payments on those bonds because failure to pay would likely result in loss of voting control of the shares in trust. Failure to resolve the default ultimately could result in forfeiture of the shares. Sinking fund bonds are debt securities which obligate the issuer to retire some portion of the debt prior to the stated maturity. Bond issues containing a sinking fund indenture are sometimes referred to as sinkers. Sinking fund bonds are issued as a way of trying to allay investor concerns about default. In effect, the issuer is putting itself on a budget. From the perspective of the issue as a whole, there is reduced uncertainty regarding return of principal compared to a term bond of the same maturity without such a sinking fund. Investors don't have to wait until maturity to see if the issuer can repay the borrowing. The issuer is repaying the debt gradually over time. An example of a sinking fund bond. Let's say there was a $100 million par value 10-year sinking fund bond with the following sinking fund schedule. The issuer is obligated to retire $10 million par value per year starting on the 5th anniversary of the issuance. By each of the 4 subsequent anniversaries, the 6th through the 9th, the issuer is obligated to retire another $10 million par value of bonds. It's easy to see that if the issuer honors the sinking fund schedule, by the time of maturity, 10 years after issuance, there is substantially less than the original $100 million par value of bonds still outstanding. If the issuer had met the sinking fund schedule, $50 million par value of bonds would have been retired prior to maturity, so only $50 million would be remaining outstanding to be retired at maturity. Should an investor buying this sinker view it as equivalent to a term bond maturing in 10 years, assuming the two had the same credit rating? This sinking fund bond cannot be analyzed as a simple 10-year term security. An investor in a sinking fund bond is buying a security for which the specific retirement date cannot be known with certainty. The various means of meeting the sinking fund requirement, at random par calls or secondary market purchases, will be discussed in more detail shortly. But regardless of how the issuer satisfies the sinking fund requirement, 10% of the issue must be retired by each of the 5th through 9th anniversaries, the remaining $50 million at the stated maturity. An investor has no control over retirement through at-random par calls, so the specific bond they hold might be retired at any one of the specified anniversary dates or may be outstanding until maturity. Since the length of time over which a particular bond will pay coupons or when its principal will be returned cannot be known, investors have to analyze sinking fund bonds from the perspective of the average life of the entire issue. On average, how long is each dollar of principal outstanding and paying interest? Sinking fund bonds need to be analyzed from the perspective of the average amount of time each dollar is outstanding and paying interest rather than simply the date when the final dollar of principal is due. With the simple sinking fund schedule posited in the example, the average life would be 8.5 years. So an investor comparing this 10-year sinking fund bond to a straight 10-year bullet bond, one with no retirement of principal prior to maturity, the two securities would not represent equivalent risk. The sinking fund bond has a shorter average life, which means it likely trades at a lower yield, and its price would be a little bit less sensitive to interest rate changes than the 10-year bullet. Sinking fund provisions can be more complex than the simple sinking fund schedule in this example. One common complicating factor is the existence of a multiplier. A multiplier in a sinking fund provision gives the issuer an option to retire more than the amount specified in the sinking fund schedule. For instance, say the sinking fund indenture specified a multiplier of 1.5 times. The issuer would still be obligated to retire $10 million par value by each of the 5th through 9th anniversaries, but at its option it could retire 1.5 times that amount, or up to $15 million by each of those dates. If the issuer were to retire the maximum allowed by a 1.5 times multiplier, $75 million of principal would have been retired prior to maturity, leaving only $25 million to be retired at maturity. The existence of a multiplier creates uncertainty about the average life of the sinking fund bond. At each of the designated times, the issuer can retire as little as the minimum amount required, or up to the maximum amount allowed by the multiplier, or anywhere in between. So if the sinking fund indenture was based on the original amortization schedule, but included a multiplier of 1.5 times, the bond issue could have an average life of as long as 8.5 years, but as short as 7.75 years, or anywhere in between those two bounds. It was mentioned earlier in passing that there are a number of different ways to satisfy the obligation to retire bonds under a sinking fund provision. Sinking fund provisions do not require a certain par amount of bonds be called by a certain date. Rather, the issuer is required to hand over to the indenture trustee a specified par amount of bonds by a certain date as proof of fulfillment of the sinking fund debt retirement provisions. One possibility is to retire bonds via an at-par call. Alternatively, issuers can retire bonds through secondary market repurchases. Make note of the phrase at-par calls. Most callable bonds are callable at the issuer's option. Usually, issuers will find it advantageous to retire bonds via an optional call because the issuer can borrow at lower rates of interest than the coupon being paid on the bond. Thus, optional calls of bonds usually result in investors having to surrender bonds carrying above-market coupon rates. To compensate investors, the issuer normally has to pay a call premium if the call was at the issuer's option. Debt retirement to satisfy a sinking fund indenture is not optional. It's a debt retirement mandated by contract. Consequently, sinking fund calls are typically done at par. The investor receives no premium when a bond is called pursuant to a sinking fund provision. Naturally, at-par calls would be the optimal way for an issuer to retire debt if the bonds are trading at a premium to par. However, secondary market purchases would be the more optimal strategy from the issuer's perspective if the bonds are trading at a discount to par. If bonds are trading in the secondary market at, say, 85, why retire them via a call at 100? The issuer can go into the secondary market and buy them at 85. So in a rising interest rate environment, when bond prices fall, secondary market purchases will be the likely method issuers would use to satisfy the sinking fund obligation. Issuers are not obligated to call bonds. They are required to retire a certain amount of face value. And if the bonds are trading at a discount to par in the secondary market purchases would represent the cheaper alternative. However, there is a benefit from the investor's perspective related to the secondary market repurchases. Markets will recognize when issuers are likely to satisfy their obligation to retire debt via the secondary market purchases. Sinking fund bond prices will tend to decline less in a rising interest rate environment because the issuer will be buying up bonds in the secondary market. More buyers, additional demand, is likely to put upward pressure on price, no matter who's doing the buying, investors or issuers. So sinking fund bonds tend to be better defensive holdings in a rising interest rate environment versus bonds that have no sinking fund provision. Another structure to consider is split coupon bonds, which were touched on briefly earlier in this module. In most cases, when there are multiple fixed coupon rates, the coupon rates increase over time. Such split coupon bonds are called step-up notes, as the coupon rate steps up over time. Here you see an illustration of a split coupon issue showing lower coupon payments over the first 6 periods, after which the coupon rate steps up to a higher level, which is maintained over the next 6 periods to maturity. In most split coupon issues, any change or step up in the coupon is purely time-based. This exhibit illustrates a single increase in the coupon rate, which is probably the most common variant, but the bond indenture could allow for more than one scheduled change over the time to maturity. The typical motivation for time-based step-ups is to allow the issuer to conserve cash in the earlier years of servicing the debt when they're paying the lower below-market coupon. The compensation to investors is the higher coupon due in the later periods, which was above market rates at issuance. The benefit to the issuer is not a lower borrowing rate overall. If anything, the issuance yield is probably a bit higher than on a single rate bond issued at the same time, because more of the return here is deferred, tied to the higher coupon in the later years. The benefit to the issuer is preserving cash for funding operations in the early years of the issue due to the reduced coupon. Such structures would be particularly attractive to young, rapidly growing companies desiring the additional cash to fund that growth, or companies undergoing a reorganization needing to conserve cash while restructuring, hopefully to return to profitability. This is a structure that's more commonly seen in the high-yield segment of the bond market as opposed to the investment-grade sector. While most coupon rate changes or steps are time-based, they can be event-based. The increase in the coupon rate could be tied to some adverse event like a credit rating cut or a bond price falling below some specified level. Naturally, a credit rating cut or a price decline is an adverse event from the bondholder's perspective. A coupon increase would be a way of compensating the investor for that adverse event. Colloquially, such indentures are referred to as make-whole provisions. The size of the coupon adjustment is a function of the specifics in the trust indenture. The indenture might allow for the adjustment to be a single step to a specified level triggered by some event. For instance, the indenture provision might require that if the issue's credit rating gets cut to less than single A+, the coupon rate will increase from, say, 5.5% to 7%. Some bond contracts would require the coupon be reset to a level that would cause the bond to trade at par. A common way of segmenting the fixed income markets is by credit sectors. When assessing corporate fixed income securities from that perspective, the market is often divided into two broad categories, which we encountered earlier when discussing credit risk: investment grade and high yield. Be clear about the reference implicit in the name high yield. High yield securities are called that because they trade at much higher interest rates, higher yields to maturity, than investment grade corporate or treasury securities of the same maturity. It's true that over most periods these securities generate higher returns than other fixed income asset classes, but the name is a reference to the rates at which they trade, not an implicit guarantee of high returns. High-yield securities are also sometimes referred to as junk bonds. One needs to realize junk bonds is a name, not necessarily an accurate characterization of how these securities behave as investments. The corporate high-yield sector experiences a much higher default rate over time than any other sector of the U.S. fixed income markets. But markets attempt to price relative to risk, such that despite the higher default rate, the high-yield sector as a whole is usually the highest return fixed income sector in most individual years and over nearly all long-term investment horizons. Though known by other names prior to the late 70s or early 80s, high-yield securities or junk bonds have been around as long as there have been credit ratings. Many mistakenly ascribe the creation of the junk bond market to Mike Milken and Drexel Burnham in the late 1970s. Milken and Drexel didn't invent junk bonds, however, they fostered a significant change by being the primary driving force in creating a new issue market for high-yield securities. Recall what makes a fixed income instrument a high-yield security or junk bond. It's a definition based on credit ratings. Before you are the main rating categories from the Standard & Poor's credit rating system. The dividing line between investment grade and high yield falls between BBB and BB. Bonds rated BBB- or higher are considered investment grade. Bonds rated BB+ or lower are considered high yield securities. Prior to the late 1970s, instead of being called junk bonds or high yield securities, such bonds would have been referred to as speculatively rated bonds or lowly rated securities. The fixed income markets of today are significantly different from the market before, say, the 1980s. And that isn't a reference to the dramatic change in the technologies that support trading, though certainly the evolution of information and communications technology have fostered the change I'm referencing. Rather, it's the way bonds are viewed as an asset class, or how their investment characteristics are assessed, that changed radically. Prior to the late 1970s or thereabouts, investors thought of bonds as where one put their safe money, money with which an investor didn't want to take any risk. Given that perception of the desired characteristics for the asset class, it's probably not surprising there was no new issue market for high-yield securities. Only companies that qualified for an investment-grade credit rating could sell new issues of debt. That was a direct corollary of investors thinking of bonds as investment vehicles for money with which one doesn't want to take much risk. The goal was to hold debt on which there was little or no likelihood of a default. Investors seeking higher rates of return would go elsewhere and trade equities or real estate or commodities. Bonds was where investors put their safe money. In such an environment, there was no demand for new issues of debt securities with less than an investment-grade credit rating. The high-yield bonds that existed prior to the late 70s or early 80s are what today would be referred to as fallen angels. As the new issue market was only open to investment-grade issuers, new bond offerings invariably had an investment-grade credit rating when they came to market. For some issues subsequent to their offering, whether due to bad decisions by management, a tough competitive environment, or whatever, the issuer's financial circumstances deteriorated. For some issues, the deterioration was so great that the credit rating would get cut to less than investment grade, to less than BBB minus. That credit rating cut from investment grade to less than investment grade representing a sort of fall from grace, ergo the appellation fallen angel. How could anyone want to hold an investment referred to as a junk bond? Of course, among market professionals, the preferred terminology is high-yield security. Calling them junk bonds may make for punchier prose, but for those unfamiliar with investments, the name could easily mislead about the investment characteristics of this asset class. As was indicated previously, junk bonds is a name, not an accurate characterization of these securities as investments. Consider the investment performance of high-yield securities versus investment-grade bonds. In terms of average default rates, unsurprisingly, high-yield securities will default at significantly higher rates. On average, the percentage of investment-grade bonds that default per year is minuscule, well less than 0.5%. Often, for stretches of many years, there are no defaults by investment-grade issuers whatsoever. In a sense, that shouldn't be surprising. When it occurs, deterioration of creditworthiness is usually not a sudden event, but a gradual process that takes place over years. By the time financial conditions have deteriorated to the point where default is likely, most corporations had long ago been downgraded to less than investment grade. The average default rate on high-yield securities is markedly higher. Most studies find an average default rate of around 3%. While 3% is the long-run annual average default rate, the rate varies dramatically from year to year and over time. In periods of relative economic strength, default rates will be extremely low. In each of the last several business cycles, there have been periods of between 2 to 4 years without a single high-yield default. However, in a really weak economy, the default rate tends to spike. In the depths of recent recessions, 12 to 13% or more of the outstanding high-yield market has been in default. That means on average about 1 out of every $8 of par value of junk bonds outstanding would typically be in default in a very weak economy. So junk bonds clearly default at higher rates compared to investment-grade securities. Yet on average, the market prices bonds at yields. That means long-term investors in diversified portfolios of high-yield securities have been richly compensated. Over time, the high-yield sector has historically generated higher returns than any other sector of the fixed income market. The high-yield market does not have the highest return every year, and indeed has underperformed for periods of 2 or 3 years at a time. But once the holding period is stretched out to 4 or 5 years, junk bonds are usually the highest returning sector in the U.S. fixed income markets going back more than a century. So yes, junk bonds or high-yield securities default at significantly higher rates over time, but the market apparently compensates by pricing in a greater likelihood of default. Junk bond indexes tend to outperform similar duration indexes of both investment-grade corporates and treasury securities. Let's dig a little more deeply into the investment characteristics of high-yield bonds. So far, the discussion has focused mostly on credit risk and the expected higher return over time. What about in a portfolio context? How would the inclusion of high-yield securities impact the expected return and risk of a multi-sector fixed income portfolio? Compare two portfolios. Portfolio A comprised of 50% U.S. Treasuries and 50% AAA-rated corporate bonds, and Portfolio B comprised 1/3 of Treasury securities, 1/3 of AAA-rated corporates, and 1/3 BB-rated corporate bonds. Assume the Treasury and AAA-rated corporate securities held in the two portfolios are the same bonds. Which of these two portfolios has the higher expected return? Unsurprisingly, Portfolio B, which includes the same Treasury and corporate securities, but also includes a 1/3 allocation to a higher expected return asset class, the high-yield securities, is the portfolio with the higher expected return. Which portfolio has lower expected risk? The answer to that question depends crucially on how one defines risk. There are many different types or dimensions of risk. If assessing the portfolios from a credit risk perspective, Portfolio B clearly has more credit risk because of the portion of the holdings allocated to securities rated less than investment grade. But there are many ways to assess risk. One way to assess risk from a broader perspective is to include the impact of all risks, which would be reflected in the variability of return. Volatility or variability of return is a widely used measure of portfolio risk. Perhaps somewhat counterintuitively to someone who's never had a course on investing or portfolio management, Portfolio B would have the lower expected variability of return. How is it that a portfolio including the riskier asset class is the less risky portfolio? Remember, we're assessing risk not from a single perspective such as credit risk, but a more encompassing perspective as quantified by the variability or volatility of return. Without getting too technical about it, the variability of expected return of a portfolio depends on the correlation of the returns of the different asset classes in the portfolio. Stated more simply, do returns on the different asset classes tend to move together most of the time? Or do the returns on the different asset classes seem to move independently of one another? That depends on the risks that are the primary return drivers of the asset classes in the portfolio. Asset classes with the same primary return drivers will likely have a higher correlation of returns. Asset classes with different primary return drivers will have lower return correlations. In Portfolio A, returns on treasuries and AAA-rated corporate bonds have relatively high correlations. That's because the primary return driver in either case is the price of credit, which is mostly a function of real interest rates and expected inflation. Presumably, that's what's reflected in treasury rates. AAA-rated corporates would trade at higher yields, reflecting some credit and liquidity risk. But credit risk is minimal concern with AAA-rated corporate securities. So the returns on those two asset classes in Portfolio A would tend to move together. Portfolio B includes those same two asset classes, but includes an additional asset class, the high-yield securities. High-yield returns are much less sensitive to the factors that impact Treasury and upper investment-grade corporate returns. Remember, high-yield bonds trade at significantly higher yields to maturity, reflecting the much greater credit risk. It's usually changes in those credit spreads that is the biggest return driver of high-yield securities. Naturally, changes in credit spreads reflect a change in the level at which markets are pricing relative credit risk. Credit risk considerations in part relate to the overall credit environment in the economy or general business conditions. More important than general business conditions are the strength or weakness of the business and financial conditions of the sector in which the issuer operates. Most important of all is the company's creditworthiness and competitive position in its own right. Note how the primary return drivers of BB-rated corporates differ significantly from that of AAA-rated corporates or treasuries. The difference in return drivers results in low correlation of returns between high-yield securities and the other two asset classes. High-yield securities offer investors a sort of free lunch. By adding high-yield securities to a portfolio of investment-grade corporate securities and/or treasury securities, not only results in a higher expected return because of the addition of the higher return asset class, the portfolio would also have lower expected risk in terms of variability of return because of the lower correlation of returns of the third asset class with the other two. A discussion of preferred stocks might seem out of place in a presentation that deals primarily with debt instruments. However, the module is entitled Corporate Fixed Income Securities, not Corporate Debt Securities. The coverage of preferreds is appropriately located here because even though from a legal or accounting perspective, preferred stocks are considered equity securities, from an analytic or investing perspective, preferred stocks are more similar to bonds than they are to common stocks. In fact, preferred stocks are so bond-like that when calculating asset class weights when determining a portfolio's asset allocation, Holdings of preferred stocks are considered part of the fixed income allocation, not part of the equity allocation. Preferred stocks are called that because preferred shareholders have several preferences versus common shareholders. Recall the earlier discussion of senior securities. Holders of senior securities, bonds and preferred stocks, have a senior or prior claim on the corporation to that of the common stockholders. Since preferred stocks are normally considered equity, the preferred shareholders have a junior claim relative to the bondholders. Preferreds are senior relative to the common. Some issuers will call their securities preference shares. That's preferred stock by another name. The two preferences preferred shareholders have versus the common shareholders are a dividend preference and an asset preference. The dividend preference requires preferred dividends be paid first up to an anticipated rate before any common dividends can be paid. The asset preference means a prior claim on the issuer's assets and cash distributions in any reorganization or liquidation of the company. Note the phrasing of the dividend preference. Payment of the dividends up to an anticipated rate. Common shares don't carry a contractual dividend rate. The dividend payable in any period is whatever dividend the company's board of directors declares payable that period. The contract under which preferred shares are issued normally states the dividend the issuer anticipates paying on the preferred stock issue. But it is only an anticipated dividend. The dividend on preferred stock only becomes a liability of the company once it's declared payable by the board of directors. If the board's judgment is that the company's circumstances are such that payment of the preferred dividend is not in the company's best interest, no preferred dividend need be declared or paid, and that would not be considered a default. To illustrate an anticipated dividend, let's assume a corporation had issued 3% preferred stock with a stated par value of $50 per share. That means the anticipated annual dividend is $1.50 per share, the $50 par value times the 3% anticipated dividend rate. If, as is common, the dividend is payable quarterly, the quarterly anticipated dividend would be 37.5 cents a share, the $1.50 annual dividend divided by 4. Only after the issuer had paid the anticipated quarterly dividend in full on the 3% preferred could the company consider paying a common stock dividend. The asset preference means that if a company is being reorganized or liquidated, though the preferred shares are junior to all liabilities, the preferred are senior to the common. In a liquidation, after all the liabilities are paid off, any remaining funds would be first distributed to the preferred shareholders up to the redemption value of the shares. Only after the redemption of the preferred would any remaining monies be distributed to the common shareholders. Though preferred stocks have the advantages already noted compared to common stocks, there is another significant difference that must be considered. Preferred stock is known as limited equity because there are limitations on both the dividend preference and the asset preference on most preferred stocks. Generally, preferred stock dividends are limited to the anticipated amount no matter how great the profitability of the issuer. Similarly, the asset preference is limited. No matter how much cash might remain after liquidation of the company's assets and retirement of all liabilities, preferred shareholders only have the right to receive the redemption value per share, which is normally the par value. All cash beyond that would belong to the common shareholders. Preferred stock with no additional features, that is, preferreds that exhibit only the basic characteristics described so far, the dividend and asset preferences subject to the cited limitations, might be referred to as straight preferred. Such preferred shares are not very common. The vast majority of preferred issues will have one or more additional features that can significantly impact expected return and risk. Let's discuss some of the other features commonly carried by preferred stocks. The vast majority of preferred stocks are cumulative. With cumulative preferred, if the issuer ever fails to pay the anticipated dividend in full, the omitted dividend is not simply forgiven. Any omitted dividends will accumulate. And before the issuer could pay a common dividend in a future period, the issuer would be required to pay not only the cumulative preferred dividend for that period, the issuer would also have to make good on any previously omitted cumulative preferred dividends. Common dividends could only be declared after the current period preferred dividends and any arrearages were paid in full. Some variation of a cumulative feature is in the vast majority of outstanding preferred issues. Many preferred stocks are callable. Just as issuers sometimes prefer to have the flexibility of being able to retire debt prior to maturity to manage their capital structure and cost of capital, issuers at times desire the same flexibility with capital raised through the issuance of preferred stocks. When interest rates decline generally, or an issuer's creditworthiness has improved, that issuer would likely be able to sell preferred stocks with a lower anticipated dividend yield. If previously issued preferreds with higher anticipated rates were called, the issuer could reduce the cost of capital by issuing new preferred shares at the lower dividend rate. Preferred shares might also be convertible. Convertible preferred stock could be converted into some other security, usually at the preferred owner's option. Usually convertible securities are convertible into other securities of the same issuer, most often the issuer's common stock. The investment characteristics of convertible preferred stocks are very similar to those of convertible bonds. Convertibles haven't been discussed yet, but will be covered in detail shortly. We'll address the impact on risk and expected return of the conversion feature at that point. Just as with bonds, preferred shares will often have credit ratings. Similar to the way bond credit ratings assess the issuer's ability to pay its obligations in full and in a timely fashion, preferred stock credit ratings assess the issuer's ability to pay the anticipated dividend in full and on time. Note the many bond-like features carried by preferred stock: senior to common, accumulation of missed payments, call provisions, conversion features, and credit ratings. Given that preferred shares have so many bond-like features, it's unsurprising that from a trading, analytic, and investment perspective, preferreds are viewed as more akin to bonds than common equities. So despite the fact that preferred stocks are usually considered equities from a legal and accounting perspective, preferred stocks in a multi-asset class portfolio will be accounted as part of the fixed income allocation, not part of the equity portion of the portfolio. Convertible securities are financial instruments that are convertible into something else, usually some other security. Most convertible securities are bonds. However, as we had just discussed a few moments ago, some preferred stocks are also convertible. Regardless of whether bonds or preferred stocks, if convertible, the contract under which the securities were issued will specify any circumstances under which the securities would or might be converted, as well as the terms of the conversion. With most convertible securities, conversion is at the holder's option, though there are some convertibles where the conversion is mandatory under some circumstances. Most frequently, convertible securities are convertible into the same issuer's common stock. However, securities have been issued that are convertible into a variety of assets. Some bonds are convertible into a different issuer's common stock. Depending on the particulars of the issue, such bonds are known as either exchangeable bonds or as structured notes. Some bonds are convertible into the same issuer's preferred stocks. Sometimes preferred stocks or bonds are convertible into other bonds of the same issuer. There are even commodity convertibles, typically issued by commodity companies, oil producers, gold miners, and the like. These bonds usually do not have a physical delivery feature. Commodity convertibles are normally cash settled. In other words, the maturity value will be the greater of either the par value of the bond or the market value of the specified number of ounces of gold or barrels of crude oil, or whatever commodity the bond is convertible into. Convertible bonds have features that make them potentially attractive to both issuers and investors, although for different reasons. The attraction to issuers is the lower yields and coupon rates at which they can borrow funds through issuance of convertibles. For conventional convertibles, where the bond is convertible at the investor's option, The attraction to investors is participation in the underlying stock's appreciation, with downside protection implicit in the coupon and principal payments on the bond. The investor can select the higher return alternative, whether it's collecting the bond cash flows to maturity or call, or if the security is more valuable for the stock it's convertible into, the holder can tender the bond for conversion into the company shares. For those securities convertible at the holder's option, the rational investor will normally not choose to convert until the last possible moment, either just before the bond is retired via a call or just prior to maturity. At that point, it will be obvious whether the conversion or the bond's retirement value generates the better outcome for the investor. As investors get to choose the better of the two outcomes, unsurprisingly, convertible bonds are in high demand on the part of investors. And that's the attraction to issuers. Because convertible bonds are so attractive to investors, issuing convertibles permits issuers to borrow more cheaply than if they were to issue straight or non-convertible debt. In other words, the convertible bonds can be sold with lower coupons than otherwise similar non-convertible bonds, the lower coupon reflecting the implicit premium the issuer is earning for selling the conversion option. Of course, the lower borrowing rate is a direct consequence of the conversion feature. In effect, the investor is buying a call option on the securities into which the bond is convertible. The premium the investors are paying for that call option is reflected in the lower coupon payment. What is especially appealing about convertibles, where the conversion is at the holder's option, is that the investor gets to choose between the two alternatives after it is already known which of the two will be the more optimal choice. How about a visual to illustrate the concepts underlying a convertible bond's value? Let's look at a set of diagrams that reflect the better of two possible outcomes the convertible bondholder would have to choose from. The better alternative for the investor establishes a floor value that convertibles must trade above. Those floor values reflect the investment returns related to the two general outcomes to the investor: participation in upward movements of the stock, with downside exposure limited to the investment value of the bond. In the three diagrams on the exhibit, the vertical axes reflect the value of the contract feature being discussed. The horizontal axis, the price of the common stock the bond is convertible into. The two left-hand panels reflect the value of the constituent elements of a convertible bond. One, the bond cash flows, referred to as the investment value. The other, the value of the stock obtained from conversion, an amount referred to as the conversion value. The lower left-hand panel shows the investment value of the bond. In general, the value of the bond's cash flows would not be affected by movements in the stock price. That's why the red line indicating the value of those cash flows is flat and parallel to the horizontal axis. The bond cash flow values are directly affected by other factors. Factors such as treasury rates and credit spreads and the issuer's credit rating, to name some of the more prominent factors. But the value of the coupon and principal amounts would not be much affected by the stock price going up or down. The upper left-hand panel shows the conversion value. The conversion value is directly related to the underlying stock's market price. If the stock is worthless, the right to buy such stock through a conversion is also worthless, which is why the blue line reflecting the conversion value starts at the origin. The conversion value moves on a 1-for-1 basis with changes in the common stock price. That's reflected in a 45-degree angled blue line coming out of the origin. The higher the stock price, the greater the conversion value. The single panel on the right-hand side captures the impact of combining the investment value with the conversion value, which determines the minimum values the convertible will trade above. This diagram conjoins the values of the two components. When conversion is at the holder's option, as was discussed earlier, the investor will get to choose the higher return alternative. That's reflected in the green function on the panel. Note the point where the lines reflecting investment value and conversion value cross. At stock prices below that value, the value of the remaining cash flows on the bond are greater. the convertible securities value would be primarily a reflection of the value of those future cash flows. At stock prices above that crossover point, the bond is worth more for the stock it's convertible into rather than the future cash flows. So at prices above that point, the convertible's value would be primarily a function of the right to convert the bond into the stock.